The stock market has been on a roller coaster, and investors who have checked their 401ks in the past week are likely to have seen some disappointing results. The Dow Jones Industrial Average is down around 4% over the past 5 days. The S&P 500 has lost almost 5%. The Nasdaq has plunged nearly 6%. While the volatility feels unsettling, investment analysts told the Daily Mail this kind of turbulence is just part of the ride. Brett Kenwell, an investments and options analyst at eToro, says investors need to put short-term losses into perspective and should not make any dramatic moves. Over the last 50 years, the S&P 500 has averaged 3 dips of 5% or more per year, with the average intra-year pullback weighing in at about 14%, he said. So while the current decline feels scary, and could get worse, it's still well within the parameters of normal. Savers should look towards the long term, and not pull money out of the market during a dip. Plus, two-view gallery news coming out of Wall Street might worry retirement investors, but experts cautioned against emotional moves. Brett Kenwell, an investments and options analyst at eToro, says, investors need to put short-term losses into perspective and should not make any dramatic moves. Investors generally have two schools of thought. Stockholders benefit from timing the market, or time in the market. Timing the market is risky and energy-consuming. The approach requires investors to have foresight into a company's market movements, which is not guaranteed. However, investors who spend extended time in the market are likely to ride some dips, but will also see market gains. Keeping investments is particularly important for passive investors with 401ks, Kenwell said. Instead of fretting the current losses, he suggested 401k holders should take comfort in knowing that time in the market is often superior to timing the market. That's a hard pill to swallow when accounts are bleeding red, but the numbers back it up. Some of the biggest market jumps have occurred days after huge losses, analysis by JP Morgan found. In the past 20 years, stocks have posted 7 of their biggest daily gains within just 15 days of their 10 worst declines. Experts said pulling funds from a 401k after that drop could cement losses in a portfolio. Plus, two-view gallery stocks have been particularly volatile this week with a series of massive shifts. Read more. Wall Street nosedives on disappointing jobs report after nightmarish week. The main thing you want to do in times of weakness is nothing, Ross Mayfield, an investment strategist at Baird, told Money. The worst thing you can do is check your account daily, because those paper losses can spur real action. Still, ignoring your investments completely isn't the answer either. Stay the course, Rob Wilson, a financial advisor, told CBS News. But definitely open up your statements, or go online and take a look at your account and make sure you understand exactly what you own. Wilson says the most important part of a portfolio is diversity. Instead of investing in specific companies, he said retirement savings should include bonds and mutual funds. Market swings happen. But experts said the key is knowing what you're invested in and resisting the urge to react emotionally when the numbers turn red.